Let's get across the market open. Zach Riaz joining us from Banyan Tree Investment Management. Zach, happy Tuesday to you. And we saw overnight Wall Street encouraged by perhaps what they're hearing from the Trump administration, at least leaks from it in terms of tariffs that are likely to be more targeted, of course, heading towards that key date of April 2nd.
I think one CEO noted, Fortune 500 CEO noted, Andrew, that they cannot wait for 2nd April to just roll over and be done with it, to get some clarity. And that's what the market is looking for. Interesting, I think on Monday, Wall Street Journal broke the news, which was also on Bloomberg, that Trump administration was already thinking about pulling back some of the tariffs. And then overnight, he made the comment as well that, look, some countries may be exempt or we may pull back. So this back and forth is what you expect. And so, look, hopefully, I think what you'll find come 2nd of April, the world's not going to end. And just a final point on that, there's a lot that needs to get through before the actual tariffs are implemented. There's legal implications. It's not just 2nd of April that everything. Yes, there is executive orders that Trump can push through, but there are legal ramifications. There will be negotiations back and forth. They're talking about some tariffs that could take up to months. And even then, there'll be constant back and forth with the countries and the sectors that he's going after. So my view is that there is likely to be a realization this is all a much to do about nothing. Whilst the risk is there, positioning's already changed. CTAs, investor positioning is all negative. So
still pretty messy though, isn't
it?
Yeah. And that makes it hard to make a decision.
100%, which is why we walked into this first half of this year underweight risk assets, and it's worked out really well. We had a few more buffers in our global equity strategy as well. We're actually 40% US assets versus the benchmark is like 65, 70%. So we walked into knowing that this was going to be exactly what you've just termed messy. Look, Trump is trying to change behavior, and frankly, he is. Hyundai overnight announced $20 billion investment over the next 4 years, $6.1 billion in the first year. UAE, I don't know if the picture was real or not, I don't know what you can believe online. UAE has proposed $1.4 trillion over the next 10 years investing in US assets and US market and US economy. He's going out there, changing behavior. I'm not saying right or wrong. I'm not here to argue Trump's philosophy. I'm just an analyst telling you what the ground movement is like, and he's getting some changes happening.
All right, so clearly there's a focus on earnings going forward,
Yes.
but at the same time you're saying liquidity is also coming back into the market.
Yeah, so look, let's spread some cheer around. I think the market's already focused on the negative side of what could be. They're expecting a bear market, maybe they're expecting a recession, probabilities are going up. But one of the key measures that we follow is liquidity, and that's a white chart. This is liquidity assets by global central banks, and you've seen it was declining pretty much in the back half of 2024, and it started to come back up again in 2025. So liquidity is moving back into the market. The other thing you need to be really mindful of, a lower US dollar also provides liquidity to the rest of the world. Let me tell you, we've got US dollar expenses which are monthly. An instant decline in the dollar means our next month expenses get a decline. We see a meaningful decline. So, and we've been seeing an increase in those expenses. So liquidity from a lower US dollar, liquidity from a lowest bond yields, and then central banks liquidity as well. You would have heard Fed saying they're going to ease the run off the balance sheet as well. So all of that put together, there is help on its way.
All right, well, you're looking at this positive, particularly when you take a look at history, seasonality, the S&P 500, what are you seeing?
Yeah, if you look at the seasonality chart for the S&P 500, this is a 10-year average, and you've got the highs, you've got the lows. Look, just focusing on the average, if you didn't know what was going on in the world, you just woke up and looked at data and data alone, the 10-year average for the S&P 500 suggests that March is one of the weakest months during the year, in fact, February and March. And we had this interestingly, we had this correction start when? 19th of February. And so it's followed on all the way through March. We're now entering a period of strong return or solid returns for S&P 500 all the way out to July and August. On average, S&P 500 has added 6.5% or thereabouts over the coming months. Now, add some fundamental perspective to it. If the 2nd of April rolls over, Tariffs are pretty much nowhere or thereabouts, still in negotiation phase. Earnings are still holding up. Mind you, there has been earning revisions for the S&P 500. You start to see some quarterly results come through. Maybe the average holds up. So from a positive point of view, just data alone, we're heading into a solid period for the S&P 500.
All right, now you've also looked at this in terms of presidential cycles. That said though, Zach, this is no ordinary presidential term, is it?
It never is, to be honest. It never is. Previous cycles had COVID. Previous cycles had, obviously, the Russian-Ukraine war start, inflation outbreak. It never is. But the data and the data alone, and this is going back to 1950, right? The first year of a presidential cycle is normally a pretty positive year for market. Now, to be fair, as the data suggests, if it was Biden back in there, you probably would have seen a higher market. But nonetheless, the US president, first year in the White House, suggests markets are always up on average. Now, this could still, we still expect markets to potentially rally on the back half of this year. We always expected first half to be volatile, and that's the way it's playing out. And if it all kind of just settles down, we know where we are in terms of tariffs. And like I said, going back to that Fortune 500 CEO, let's just roll over to 2nd of April. Let's just roll over to see where we are and let us start planning. And investment is going to US. So it's not a foregone conclusion that this has to be a bad year.
All right, so where are we at in the cycle right now? Given we've had the correction, certainly the S&P, the NASDAQ, investors want to know, have we seen a bottom? Is this a bear market or not?
Well, look, we don't think this is a bear market. We think this is a healthy correction. And if you just look at the sector composition of the returns. Now, what's very interesting, this is a chart that shows that every time there's been the S&P 500 has experienced a 10% correction from all-time highs, but doesn't go into a bear market. But this is just basically telling you the forward returns, unless your base case is we're going to a bear market, the forward returns are looking very good. But if you just look at the return by sector, out of the 11 sectors, only 3 sectors are in the red for the S&P 500. Do you know what's the best performing sector for the S&P 500 right now? Oil, 8.5% year to date. I thought there's a recession risk around. Have you seen copper prices? That's global growth. Why is copper prices rallying? So all I'm suggesting is that there are a lot of things to be mindful around that are positive as well. So look, this suggests to us, unless there's a bear market, which we don't think is the case right now, returns on a 6 to 12 months are likely to be positive, which comes back to that, the presidential cycle, first year return.
So Zach, let's then round it out by finishing locally, what you're seeing here, and what stocks are you actually liking at the moment?
Yeah, look, one stock that we really liked and upgraded to a buy just recently is Northern Star Resources. Gold, we like gold, but this is a stock that's making hay while the sun shines. It's improving its return on invested capital. It's got tier 1 assets. It's got organic growth coming through in terms of production growth, and you've got at the headline level gold prices, which are very much buoyant. And I think there is an argument, and we have made this for a while now, that gold prices are going to $3,500. Look, if Trump continues, think about this. If Trump continues with his current strategy of putting everyone on the offside, maybe the US becomes a bit of uninvestable. They said this about China, so you don't go to US treasuries, you don't go to US assets as a safe haven, you go to gold, which is a globally recognized safe haven. So gold prices remained elevated, and gold equities continue to, as long as they're good quality stocks, continue to make hay while the sun shines.